All right, it's time for Uncovered Asia. My name is Andrew Stotz, and let's look at this company. How long does the steel demand surge last in the face of soaring prices? That's my question for you. This is Uncovered Asia. My name is Andrew Stotz, and welcome to Uncovered Asia, where I explore interesting stocks in Asia that few institutions and analysts cover. Today's company is Chung Hung Steel. All right, well, let's look at this company. Remember, this is not investment advice. This is me talking to you about a stock that I think is interesting. I'm not telling you to buy it. I'm not telling you to sell it, but I'm saying it's worth looking at. And I'd love to hear your questions or comments about this company. All right, so it's an Asian steel player with international alignment. Chung Hung Steel is part of China Steel Group, the largest steel producer in Taiwan. As of 2020, it had 5 factories across Taiwan with an annual capacity of 2.4 million metric tons for its main product, which is hot rolled coil. 37% of its revenue is derived from exports. So there's 3 things to know in what I'm going to talk to you about. First, global steel demand recovery provides short-term profits. Second, vertical integration allows for effective cost control. And third, unlocking export potential to Vietnam could drive revenue further. Let's look at the company in a little bit more detail. First of all, you can see 77% of revenue is coming from hot rolled coil. The main use is for railroad tracks, kingpins, chain pins, steel pipes. Another 14% comes from cold rolled steel. This is home appliances, metal furniture, school lockers, things like that. And then a tiny amount comes from galvanized steel coil and steel pipes. So this is a steel company. Now let's take a look at the revenue structure. Here we can see it in Taiwanese dollars that are in billions, and we can see that it peaked in 2018 at a little bit over 45 billion, let's say close to 50 billion Taiwanese dollars, with the bulk of it being the hot rolled coil. Now we can see that that's fallen to about 35 or so billion US dollars. But truthfully, that's a pretty small fall when you think about it, when you look at what happened in 2020. So it did pretty well. Now, let's look at this global steel demand recovery. First of all, you can see a chart of the historical information up to 2020 for crude steel production. This is in metric tons, millions of metric tons. And this is provided by the industry groups. So right now, what we can see is a fall, or let's say a tiny rise in 2021, and then a slight rise expected in 2022. So it's not, I would say it's not a fast growing industry, but it's stable, relatively stable. So let's look at the next thing. Production in 2021 has difficulties to keep up with demand. The first economic recovery has led to a situation in which steel production, the fast recovery, steel production lags the demand rebound. This has caused a boost in steel price, providing higher short-term profits. And here you can see that steel price has just been rocking up. For those people that say that there's no inflation, well, take a look at that. Steel goes into a lot of things that we consume. Now, remember, this is a very long-term chart going back to 1982. So what we're showing in that rise is what's been happening over the last 6 months or so, but it's a serious rise in steel prices. Now, vertical integration allows for effective cost control. CHSC is a subsidiary of China Steel, the largest steel company in Taiwan with more than 50% market share. The integration allows for stable raw material supply. So, unlocking export potential to Vietnam could drive revenue further. Vietnam comprises this company's most important export partner with about 17% of total revenue. Strong economic growth in Vietnam has boosted construction activities, which in return has surged demand for steel. Then there's rapid urbanization, and that's expected to increase new building construction by about 7% yearly until 2029. Let's look at the amount of volume of steel that is going to Vietnam from this company. And you can see in 2019, they had their huge increase that started to go to Vietnam. And then in 2020, it fell a bit, but not by much. Remember, Vietnam is one of those countries that just hasn't been hit that hard by the COVID crisis. Also, work that I've done previously talking about COVID crisis looked at the correlation between body weight and body fat and the amount of deaths from COVID. And we saw that Vietnam had the lowest body weight and body fat index. So obesity is the lowest in Vietnam, and they had the lowest amount of deaths. That's part of why some people say that obesity is a main factor. Let's look at the share price, what's been going on there. All right, share price has been rocketing. We can see the price change over the past 12 months has been about 580%. So really the question is, my God, will this continue? To what extent? We can see that it's recently backed off and come down. So now we have to think about whether this can sustain. So in order to answer that question, I'm going to go into my FBMR scorecard. Now, the FBMR scorecard considers a stock's investment attractiveness relative to stocks in that country or region. And attractiveness is based upon fundamentals, valuation, momentum, and risk, what I call 4 elements. I consider a company over 5 years so I can see the trend, and a scale of 1 is best, and it goes to a scale of 10, which is worst. So let's look at the company here, and here we can see the rankings. First of all, the best ranking right now is on momentum. That momentum is both earnings momentum, where we can see recurring EPS growing, but also price momentum. The second best factor is fundamentals. Now we can see a pretty significant asset turnover item of 127.8. That means that the company is generating 27.8 in dollars of revenue for every 100 in dollars of assets. Also, you can see that there's a recovery. The operating profit margin was down to minus 0.8, and then it's come back in the past 12 months. And that recovery could drive this much further because the share price has already moved quite a bit, but it looks like there's a lot of potential for earnings recovery. The ROE used to be in 22 to 24%. Right now, it's 4% in its first period of recovery. Let's look at the valuation. The valuation, price to sales about 1.1, price to book about 2.7, and price to earnings. Well, right here, price to earnings doesn't make any sense because earnings are so low that 72 times earnings just doesn't make sense. From a price to sales and a price to book perspective, I would say the company doesn't look super expensive. I wouldn't say it's cheap. Look at the price to book going in the past. It was 1.7, then down to 1.4, and then 1.1. Now it's at 2.7. We'd have to look in the balance sheet a little bit more to see what's happening. Are there accounting adjustments happening there? What is it? Now, here's part of the clue probably, and that is if we look at the risk in the bottom right-hand corner, we can see that the net debt to equity has been falling. What does that mean? The company has been paying back debt. That's a good thing during a crisis, but it also means that the equity of the company is rising. And if equity is rising, it also probably means that the price to book is being pushed up. Also, we can see that the beta is about 0.1, so there's really no relationship to the overall market. From this, I would say it's relatively attractive still, even though the share price has run. So next, I'm going to look at the world-class benchmarking triangle that I use. It helps identify a company's competitive position relative to global peers because, after all, those global peers are going through the same economic conditions. Its combined composite rank of profitability and growth I call profitable growth. And it considers a company over 5 years. And the scale is 1, best, 10, worst. Let's look at it. So profitable growth recovered to an average level of about 5, ranking of 5, after ranking worst in 2019. So in the past 12 months, compared to 760, it's actually done pretty much in line. Now let's look at where this improvement has happened from the 10. And we can see that it's almost all coming from growth. Growth went from 10 to 1. 1 is the best ranking. Where is that growth coming from? Revenue and also profit margin improvement. So that's where it's coming from. And I would say that gives me some sense that this stock looks still, to me, looks interesting at this point. What are the risk factors? Fluctuating steel prices and disruption in logistics change, foreign exchange, trade wars. And this is not risk factors related to rubber companies. This is risk factors related to steel companies. So To sum it up, the three things you need to know: global steel demand recovery provides short-term profits. Yep, that's running and it's happening right now. Vertical integration allows for effective cost control, and unlocking export potential to Vietnam could drive revenue growth further. So my question to you is, how long does the steel demand surge last in the face of soaring prices? Remember, this is Uncovered Asia. If you want to know how I pick stocks, download this free stock picking checklist by scanning the barcode. And now I'll go to any questions if we have any. Let's see, any questions? All right, so first question. Munling says, do you think steel prices are going to experience a dip next year? Yeah, I suspect you're probably right. Sometimes when you're playing these types of stocks, it's a turnaround situation, and you're catching the momentum that's happening in the stock, and you're riding that momentum, but it probably doesn't go up forever. That's because there's a lot of steel demand or steel supply that can come online. That's different from when people were buying Amazon and it kept going up and up and up. The number of competitors were really limited. But here, it's a pretty conventional business. So I suspect maybe 6 months, 12 months, we could see the end of that rally. Next question from Ravi. When comparing Chung Hung Steel and Servistol, which one do you see is more competitive? That's a good question. Servistol is a Russian company, and I think that we should be looking at this company in more detail. I think we are in the valuation masterclass. But I can't say that I have a good comparison in my mind right now. Servistol's fantastic because it's got its own coal that feeds its business, and that can be a very, very valuable thing that allows you to keep the margin in the business, but also keep stability in pricing. Next question from Titigon. Since Vietnam's GDP growth is mostly backed by FDI, will the GDP be affected if financial markets fall, like if the US market bursts? I would say that the reason why Vietnam will be affected when the US market falls is because Vietnam is a pretty small market, and the number of companies that are truly large and liquid are small. So if things get rocky in the US, we've seen it in the past that money comes back home. And that means that people will take money, US investors will take money out of all of these countries, and Vietnam, being a very tiny country, could see capital outflows, and that could be negative for their stock market. All right, Warut says, how about China Steel Corp and Servistol? Yeah, I had to look at that in more detail to answer that better. All right, excellent questions, and that is Uncovered Asia. I hope it gives you some ideas about this company, and I'll see you